Welcome to the Learning Square, and welcome to yet another topic on investment. In today's video, we will be talking about bonds. We will see what a bond is, with an example, and we'll also see the key terms involved with bonds. We will cover its advantages and disadvantages, and we'll also see how one can start investing in bonds. So stay with us till the end of this video, as we will try to provide all necessary information for you to get started with investing in bonds. Let us begin. Bond is a type of investment where an investor loans money to a borrower and gets a bond in return, with the expectation that the borrower will give him fixed interest over a period of time. This borrower is usually a company or a government that get money from the investors and pays them a fixed rate of return over a specific time. Investors usually prefer to have a diversified portfolio of investment, where they allocate a portion towards investing in stocks, another portion towards mutual funds, and so on. They also ensure that bonds are part of this portfolio, because bonds are less risky compared to stocks, and also helps generate an additional fixed income. Let us now see how a bond works in a real example. Consider a company ABC wants to create a stadium and issues bonds to investors. Investor Alex invests $1,000 for a 10-year period and gets a bond in return. As per the bond, he will be getting 5% fixed interest every year. So, Alex gets $50 every year, and when the 10-year period is over, he gets back his full amount that he has invested. In this scenario, Alex is happy because he has got back his $1,000 and an additional $500 as interest over the period of 10 years. And the company is happy because it has got the amount it needed to construct the stadium. Most bonds usually have the below characteristics. 1. Coupon rate. The fixed interest rate that the investor receives periodically is referred to as the coupon rate. In the example that we discussed, it was 5%. The rate here need not be fixed. There are bonds that are also issued with variable coupon rates. 2. Face value. This is the amount the bond will be worth at the maturity. In our example, it is $1,000. It is important to note that when the bond is being sold, the company can sell the bond at a discount, say $980, or at a higher price, say $1,050, based on the demand of the bond. There are chances that some investors could have bought the bond at $1,050, and few other investors could have bought the same bond at $980, based on the time, but both will carry a face value of $1,000, which is the amount the investor would get during maturity. This amount, $980 or $1,050, on which the investors buys the bond, is referred to as the issuer price. 3. Coupon dates. These are the dates when the bond issuer makes interest payments. It can be in any interval, but the standard is semi-annual. 4. Maturity date. This is the date when the bond matures and the investor gets the face value of the bond. So, a typical bond will have a face value, a coupon rate, a coupon date, a maturity date, and a issuer price. Here are some advantages of going ahead with a bond investment. Number 1. Bonds are a good source to receive additional income through fixed payments. Number 2. It is less risky compared to stock markets. Number 3. There are chances that you can profit selling bond to other investors at higher prices. Let us now see some drawbacks associated with bonds. Number 1. The returns are less compared to stocks. Number 2. Just like any investment, risk cannot be fully avoided. Bonds still hold risks of companies that issue bonds going bankrupt and can default on your bond. This risk is referred to as the default risk. In general, there are 4 major categories of a bond. 1. Government bonds. These are bonds issued by government. They in turn have the below 3 classification. Bonds issued with a maturity date of 1 year or less is referred to as bills. Bonds issued with a maturity date of 1 to 10 years is referred to as notes. Bonds issued with more than 10 years is referred to as bonds. 2. Corporate bonds, these are bonds issued by the companies. 3. Municipal bonds, these are bonds that are issued by state and municipalities. 4. Agency bonds, these are bonds that are issued by government-affiliated organizations like Fannie Mae or Freddie Mac. Government-issued bonds, in general, are more reliable and stable, but usually carry less coupon rate. The corporate bonds are more attractive to investors, as they offer higher coupon rates, but they also carry higher amount of risk. There are a lot of rating agencies, which rates a bond, such as Standard & Poor's, Moody's, and Fitch Ratings. The very highest quality bonds are called investment grade, and include bonds issued by the US government, and very stable companies. Though the rating can help decide which bond is better, it may not be fully accurate. It is always advisable to learn more about the company and its fundamentals before investing in them. There are basically 2 ways you can start investing in bonds. 1. US Treasury Department. You can buy new Treasury bonds online by visiting Treasury Direct. The link to the same has been added in the description below. To create an account, you must have a SSN, a US address and a US bank account. 2. Brokerage applications. Most online brokerages sell corporate bonds and municipal bonds. Brokers like Fidelity, Charles Schwab, E*TRADE and TD Ameritrade offer extensive bond listings. However, the purchasing process through an online brokerage is not as straightforward as through Treasury Direct. You can also buy an exchange-traded fund bond through your brokerage applications. Investing in a bond ETF is a good option if you don't have the cash to spend on different individual bonds. Hope you got a fair idea on what a bond is and how it works. If you found this video useful, please do like and add your thoughts in the comment section below. Please do support us by subscribing to our channel and sharing it with your friends. Goodbye, and thank you so much for watching.